This is TreppWire Week in Review for the week ending July 12th, 2024. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week, the weather across the country is hot and humid. However, inflation is cooling, dry powder is piling up, looking for an economic spark somewhere to generate transaction energy, and hopes are rising more quickly than the hygrometer for a rate cut later this fall, which could do just that. Today, we'll dive into some macro news, including CPI, provide a recap of some big office leases and their even bigger market impact. We'll dive into some CMBS issuance and new origination data, share a preview on bank earnings, and an analysis of short-term rentals. But first, we are recording this on July 11th, better known as 7-Eleven. So I have to ask you guys, what is your favorite Slurpee flavor?
Oh, it's got to be the blue raspberry, you know? I'm going to freeze my tongue. I at least want it to turn blue to represent how cold it is.
Yeah, I'm definitely more of a wild cherry kind of guy. Need the bright red tongue. Hopefully you don't get a brain freeze. But yeah, like on 7-Eleven, I think you get free Slurpees if you take a mug in there, whatever, that you fill it up. So I was Googling, Haley was doing the intro, and the hygrometer, for those that don't know, is an instrument for measuring the humidity of the air or a gas. So we've already checked that education segment off for today's episode.
So let's turn back to that 7-Eleven topic. We did see a Wall Street Journal video published this week where it talked about 7-Eleven adopting strategies from its Japanese operations to redefine how it generates revenue.
Yeah, so 7-Eleven is an interesting business. I mean, they've been pretty successful here in the US for many decades, and they've reimagined their stores and kind of their footprint multiple times over the years. So as we read the article and kind of tied into the 7-Eleven on the calendar today, we also decided to look into some of our own 7-Eleven tenant exposure information. So for those that don't know, Trepp tracks and has profiles on the top 200 tenants across the CMBS universe. So if somebody's a top 5 tenant listed in a deal, we've aggregated those tenants across the top 200. And so we have some really nice insights covering those tenant compositions. For 7-Eleven, we're actually tracking 62 properties that are currently active with CMBS loans. And the overall temperature here is pretty good. Only 3 of those are in special servicing, 29 are on the watch list, and 3 are delinquent. So generally speaking, almost 95+% of these properties are performing where 7-Eleven is one of the main tenants. So pretty nice geographical representation too across the US. Pretty large footprint out in the West Coast in California, but then all the way up the East Coast into the New York metro area. So good to see them doing well. Hopefully with them, evolving some of their strategies to redefine their business, they're able to continue in spite of some of these other, single tenant type of businesses, Walgreens, Rite Aid, and others that we've talked about struggling in today's environment.
So looking at the macro data from this week, we did see the latest consumer price index numbers, and I'd love to get your read on inflation and consumer spending.
It came as a really nice relief on Thursday morning when we had this cool CPI print. Not just cool, like this was refreshing, really good news. So for headline CPI, it came in at 3% versus expectations of a print for 3.1% and the prior month's 3.3%. Now, the really big surprise for most economists was that the month-over-month headline number actually decreased 0.1% versus expectations for an increase of 0.1. Last month, we were flat. Now, if we turn to the core CPI number, that also came in below consensus. The month-over-month number was a 0.1 increase versus expectations for a 0.2, and the year-over-year increase was 3.3% compared to an expectation of 3.4%. So all in all, this was exactly what any investors that are hoping and wanting to see a Fed rate cut sooner rather than later wanted to see happen. And ultimately, this should give the Fed some more of that confidence they've been saying they need to gain in order to cut rates. They keep saying, well, we need to see continued or sustainable path of disinflation. And so we still have, a good number of more data points to get released before the September meeting, which is not their next meeting, but that is the meeting where there's wide consensus to see a rate cut happen in September. So if we're just looking ahead, the general consensus from the street today, this was fun listening to this kind of evolve in the first hour of the trading day, was the expectations for a Fed rate cut in September for just a 25 basis point cut went from something like 80% at about 8:45 a.m. and kept gradually ratcheting up. I think we peaked out at maybe 92% chance right around 9:30 or 9:45 a.m. And so that was really interesting to see that broad consensus grow this morning. So the thought is at the July Fed meeting that, if they were to cut sooner than the market was expecting, that would be taken more of as a negative signal because, pulling those rate cuts forward would signal that the Fed has more concern about economic weakness rather than just trying to dial back the restrictive rate level that we're at right now. And so in the July meeting, expectations for the Fed to basically pre-signal that they will be cutting in the next meeting. So we'll see how that happens. That would be absolutely great news for any interest-sensitive sectors, such as commercial real estate, residential real estate. And I don't think, based on the data that we've been seeing thus far, that we'll have the reignition of the fears that easing economic conditions will lead to a reignition of inflation. I don't think we're at that same point we were, 3-6 months ago, where that was a little more of a concern.
Yeah, I agree with you, Stephen. I think we've kind of hit an inflection point where a 25 basis point reduction in the rate's not going to ignite some wild spending spree and the market's going to go crazy. Obviously, it'll be helpful. It doesn't really move the needle from a math perspective. A 25 basis point cut doesn't change your perspective if you're a CRE owner looking to refinance. Like, yes, it's welcomed. Yes, it's going to be helpful. And maybe a few properties that are fringe, this puts them in the good. But on the whole, 25 basis points on its face is not enough to move the needle. I do think, though, it kind of signifies maybe the end of the high inflationary environment and like a transition to something that's more sustainable in the marketplace. And so, the timing of this, if you listen to what Powell said earlier in the week and kind of putting this all together, like I think they're definitely setting themselves up for a rate cut. But we felt very confident coming out of December that they were setting up for a rate cut. The one caveat here is that you've seen some movement in the employment or unemployment rate that you hadn't seen leading up to this. So I think all indications lead to some sort of a rate cut sooner versus later. The interesting dynamic there is it ties in very nicely with the election cycle and everything else, which will beg a bunch of other questions. So it'll be interesting to see how the market reacts if and when the rate cut finally happens. But I think we're closer to that now than we have been at any point in the last 12 months or so.
So in the opening for the episode, we had several headlines that were tossed out that talked about buying opportunity in CRE that's coming as a result of property owners that are currently holding low interest rate maturities are staring down the decision to either refi in a high rate environment or sell. So we spoke last week about private equity accumulating about 64% of the $400 billion of dry powder, or about $256 billion, to take advantage of CRE buying opportunities later this year. These PE firms believe that office values fell by almost a quarter last year. Turning to the maturity numbers, according to Trepp's most recent forecast that is based on the Federal Reserve flow of funds data, it looks like there'll be about $600 billion of commercial mortgage loans coming due in 2024 and roughly about another $600 billion next year in 2025. So call it a nice round $1.2 trillion of CRE debt maturing in 24 or 25. Again, with a majority of that coming from banks. Around 270 to 280 billion roughly or so this year and next is coming from banks. So collectively, that's over $500 billion in CRE loans maturing on bank balance sheets. And banks, as we've talked about many, many times, have been looking to reduce their commercial real estate exposure in many cases, either through just letting the debt roll off their balance sheets or through loan sales or risk transfer. Those are the three, at least, main avenues. So Oaktree Capital says we're in a first or second inning of this realignment and that a tsunami is coming and the waters are pulling out from the beach. Lonnie, what do you think of that quote?
Well, I think it's interesting. I used to joke when I did presentations that 2019, before COVID in 2020, it was required if you moderated a panel at a conference, you had to ask what inning we were in, because it seemed like every conference you went to, at least 3 times a day, you would hear, what inning are we in? So it's funny to hear that being brought back. In that instance, it was like we're in the 7th inning of a doubleheader because the market had been on fire since the GFC. So we've reset. We're in a new game. We're in the 1st or 2nd inning according to them. And I think the analogies are fun, but the reality is we're still early. I don't know that, having a sports analogy makes sense, but there's a lot of dry powder here. But you mentioned it, 400 billion of dry powder, about 250 billion from the PE side. There was a story this week from The Real Deal talking about Lone Star Funds. They just raised 5.3 billion targeting distressed assets. For those that don't know, Lone Star Funds has about 36 billion in AUM, and their 5.3 billion fund, again, was just to go after distressed assets in the real estate sector. It'll be interesting to see, Stephen, as these maturities continue to roll over. If you had asked anyone maybe 12 months ago what we thought the level of distress would be for these maturities, people would have assumed significantly more distress than what we've actually seen. So maybe I'm a little bit numb to it at this point, but as I hear 1.2 trillion of maturities over the next, call it 18 months, that doesn't jump off the page to me at this point like it did before, because I think the interested parties are working these out in whatever form or fashion they can. And I think you're going to end up with a lot of these distressed funds eventually investing in something other than what they originally thought.
Yeah, I'm right there with you. Numb is a very good way to put it. We've seen these massive numbers get tossed around with, big old trillions after it. But, the reality is so much of this pain is staggered. And I think that's one of the saving graces this time around, is that you don't have this toxic confluence of factors all coming together at once. It's, kind of like rolling distress, which really helps spread out the pain and lessen the collective impact.
So let's switch gears and talk about some big leases that we were tracking this week. According to the Seattle Times, Microsoft is vacating its office space in downtown Washington at City Center Plaza. The company announced last year that it wouldn't renew its lease in the 26-story city center this June. Microsoft has left behind its 1.9 million square foot office space in downtown Bellevue. What is your take?
Yeah, so Washington, the Seattle market has seen a lot of these single tenant office buildings with negative news. So where they're saying they're downsizing or vacating completely. You mentioned the City Center Plaza in downtown Bellevue. This is one where Microsoft occupied about 570,000 square feet in that one building. They were the sole tenant, and they decided that they were going to vacate. Just some positive news coming out of that is the owners of that building have actually recently leased about 48,000 square feet to Clark Nuber and 49,000 square feet to HDR. So you're seeing some leasing activity in the space. But if you look at the submarket as a whole, the vacancy rate has definitely increased over the last couple of months. There's a lot of stories around the big tech companies, as we mentioned. This is a tech-heavy industry, similar to Austin, similar to San Francisco, et cetera, where as soon as people start downsizing or leaving, it has negative consequences for that market. So we pulled together some market snapshots for the Seattle MSA and the office sector. So a couple of things that we'll work through here. If you look at office vacancy nationwide, according to our data, we're sitting at about 16%. Seattle, Tacoma, Bellevue MSA is sitting at 3.23%. Now that's given that these large tenants that are vacating still have contractual lease obligations. They're not factored into the vacancy at this point. So it's significantly better than the national average, but that sublease availability or, shadow vacancy would be significantly higher than that. If we transition to look at delinquency, nationwide office delinquency right now is sitting at about 7.69%. Whereas in that same Seattle, Tacoma, Bellevue MSA, it's currently sitting at 3.4%. So as you mentioned, Stephen, some of the staggered nature of the lease rollovers, even though a company announces they're going to vacate, but they still pay the rent, there's a lot of positive news in the negative stories. And I think a couple of these leases that we talked about in that particular Bellevue market in the City Center Plaza indicate that there's some life there. We also have obviously a lot of income and expense data broken out for each of these MSAs. And so there's been some significant changes on the rental side, rental rate side, as well as the expense side for the Seattle market. If you're interested in getting a snapshot of that market for the office sector, reach out. We'll be more than happy to send you a snapshot.
So we've been seeing a lot of big subleases in this submarket. For instance, we recently wrote on Intellectual Ventures offering for sublease its 152,000 square feet of office space at Sunset North, a 464,000 square foot property in Bellevue, Washington. This property was built in 1999 and renovated in 2019. Intellectual Ventures is the largest tenant at the property, which is nearly fully occupied, and Intellectual Ventures has a lease expiration in May of 2025. WeWork, of course, we couldn't go an episode without mentioning WeWork. They are also a tenant at the property. They take up just under 17% of the space, with a lease ending in 2031. The local private equity company is leasing the space on a deal that runs through next May. The offering could be an indication that the company will not extend its lease at expiration. Sunset North at 3120, 3150, and 3180 139th Avenue Southeast is encumbered by $150 million of CMBS debt that's split across 4 deals. So one thing to keep in mind with these subleases and with the downsizing is that, as we've seen with many other markets, there is a potential knock-on effect for local businesses, multifamily housing, and other services in the area that's supported by the employment in these office buildings. And so while Seattle looks pretty good on the CMBS side in terms of risk and loan performance metrics, like Lonnie said, there is still a staggered lease rollover schedule. And so some of this stress, or I should say, stress test to some degree, has yet to roll through. And so this is just going to be a market to keep your eye on. Also, over in Boston, we saw several large renewals. After considering relocating, Vertex Pharmaceuticals has renewed its lease for 1.13 million square feet at the Fan Pier office property in the Seaport section of Boston, as reported by BizNow. The company occupies the entire office portion of the property at 11 Fan Pier Boulevard and 50 Northern Avenue, which is owned by RMR Group. It serves as Vertex's headquarters and includes 60,000 square feet of retail space as well as underground parking. The property was developed in 2013 specifically for Vertex, which was subject to a lease that runs through 2028. Now, this property is encumbered by $425 million of debt, and that's securitized across 7 CMBS deals. So just elsewhere, Vertex also occupies 269,000 square feet of space at 316 to 318 Northern Avenue in Boston, and also signed a lease for 344,000 square feet at 20 to 22 Dry Dock Avenue, also in Boston. And that's in process of being developed by Related Beal.
Yeah, Stephen, it's great to see some of these large renewals take place in the market. And you mentioned a couple of things that I wanted to circle back on. Fan Pier, you said, is encumbered by $425 million in outstanding debt, and then it was securitized across 7 CMBS deals. So for our listeners that maybe are new to the structured finance world or new to CMBS, can you give us a little bit of a primer as to why these large loans may be structured across multiple deals, or just how does that process play itself out?
Sure. So in traditional conduit deals, while you do have a good amount of the pool collateral accounted for by the top 10 assets, you don't want any of those, say, top 10 loans to be so large that a loan kind of has an outsized impact on the collateral cash flows. So what ends up happening is, we could take this $425 million loan and put it in just a single asset, single borrower deal. And then that $425 million would just be in one CMBS deal. So that's one option. The alternative would be to split it up into multiple pieces, in this case 7, and spread it across a number of different deals to lower the concentration risk. Because the rating agencies do look at what's called the Herfindahl score. It's basically just a measure of how concentrated the collateral is toward the top end of the pool on a dollar-weighted basis.
So let's shift gears and move over to the banking world. We published a bank earnings preview looking at Q2 2024 bank earnings and projected headwinds for the top 4 banks. So I know we will start to see some bank earnings come out tomorrow.
Yes, there's already been some nice reporting around just the banking sector. For those that maybe haven't read, Bloomberg reported that all 31 major banks that underwent recent Fed stress testing this year, all of them passed and maintained adequate capital, even in what they consider severe economic scenario, which if you actually dig into that, you can see what those underlying parameters are for the severe scenario, which are pretty significant. But they contend the stress tests are flawed. Banks still have poor understanding of their own risk, and regulators may yet succumb to a dangerous complacency. It'll be interesting to see what the bank earnings say outside of the stress test results. I know, Stephen, we run our own Trepp version, the Trepp capital adequacy stress testing models against bank earnings. And so we've done some forecasting here. What are your thoughts?
So, given where we're at in the interest rate cycle and the trends that we've been seeing evolve over the last couple of quarters, our capital adequacy stress test model, or the TCAS model, is predicting a significant year-over-year decrease in earnings for the top 4 U.S. banks. After a 2% increase in the first quarter of this year, revenues are expected to drop by approximately 6.1% in Q2. Net interest income, a major factor for banks, is projected to decline a pretty good bit here in the second quarter, reversing the modest 0.8% growth seen in Q1. Now, the exact magnitude of this drop is to be determined because, as we've seen over the last few quarters, the flight to safety with deposits being pulled from smaller and mid-sized banks and moving into the larger banks, in particular the top 4 that sometimes are referred to as having, at least one in particular, is referred to as having a fortress type balance sheet. That's definitely where you want to fly to safety, is to go to an institution that has a balance sheet that's described as a fortress. And so they haven't had to pay out as much on deposits as some of these smaller mid-sized banks that have been having to ratchet up the interest rate they're paying out on savings accounts. The big 4 have largely been insulated by that. However, that has started to pull back a little bit, and I've seen a couple articles over the last 3-4 months projecting that these large banks will have to gradually ratchet up. They're in a very precarious situation because if they can, they would prefer to hold off on ratcheting up the savings yield and maybe get by with keeping it status quo until after rates get cut, right? That will alleviate some pressure on them to ratchet up savings yields. So non-interest income, there might be some positive news to look for here. Non-interest income is forecasted to rise by 8.8% in Q2, up from the 3.4% increase we saw in Q1. And the overall impact here is that the net result for the largest banks is projecting a 26.3% drop in net earnings for Q2. And that's in stark contrast to the 7.6% decrease we saw last quarter. So the net interest margin, so that's what I was referring to earlier, that margin matters a lot to banks. And it has been on a decline, dropping to 2.34% in Q1 from 2.43% in Q4 of last year. So we're looking for that to continue sliding downward in Q2 of this year. So higher interest rates can widen net income margins by allowing banks to charge more on loans while keeping deposit rates low. But as I said, the current environment has reduced borrowing volumes and increased default risk, along with the stickiness in deposits and really lack of motivation for these banks to feel pressure to increase those deposit yields. That's helping to offset some of that pain from the increased defaults and reduced borrowing demand. So we'll be releasing this official Q2 bank earnings review soon. So be sure to keep an eye out for that on Trepp Talk.
Yeah, I don't want to discount the positive news that the banks passed the stress testing. I mean, like, given all the distress in the market and the perceptions of everything doom and gloom, while you could contend that the stress testing is flawed and bank earnings are going to be down and there's all this downward pressure on the sector, at least there's some silver lining in the fact that under the severe economic scenario, banks passed the test, and we'll know more in the next coming days and weeks in terms of what the bank earnings actually are. And we'll obviously talk about that. I think this will make some really good discussion points for this upcoming month's Market Pulse webinar, Stephen.
And on the topic of banks, we're seeing increased headlines and news about regulation. And just yesterday, we saw that Citigroup will pay almost $106 million in fines to U.S. bank regulators over issues related to data quality management. And CEO Jane Fraser said that Citi hadn't been fast enough in addressing data quality management.
Yeah, it's not uncommon for us to see the regulators come in and these banks end up having to pay, sizable fines. But on a relative basis, These are, I wouldn't say inconsequential, but I think they're utilized to try to get the banks to take action when they otherwise wouldn't. So in this case, not knowing the full details, hopefully whatever was causing the regulators to, think city hadn't done enough, this incentivizes them to get that under control and get their data management issues, rectified. So the market benefits from them being on top of that.
So this week, our rundown readers would have seen a teaser of this, but we finished compiling our first half CMBS issuance data, and we shared some of what we've learned about lenders, their tendencies, and some of the insights into how many deals got done so far.
Yeah, so we put together a really nice review of issuance relative to 2019, first half of 2019, right? So if you joined us for any of our Market Pulse webinars, Steven's done a really great job of kind of saying pre-COVID 2019 is kind of a benchmark year for us to look at maybe what current activity looks like. Because if you look at 2020 or 2021, 2020 is obviously on the very low end with COVID, 2021 is obviously on the very high end with the stimulus. 2019 seems to be a good bellwether. So far this year, there's been 13 conduit deals issued with an aggregate balance of just over 13 billion. So 13.11 billion to be exact have been issued. That compares, I think, favorably. It's less than, but favorable. 21 deals, 18.2 billion during the same time period in 2019. So it's, $5 billion less than what it was in 2019, but all things considered, given where we're at coming through the cycle with COVID and now with the higher interest rates, if you had asked people, I think they would have suggested that you'd be looking at something like maybe half in terms of total issuance on that same time period. 13 to 18, I think, is a pretty good indication for how resilient the market is. Now, that doesn't mean it's without some changes to the underwriting. And so I know, Stephen, for you, you're going to give us some property sector specific information on loan to value and other things. But if you look across the 13 deals that have been issued, this is at an aggregate level. Across the 13 conduit deals that have been issued in 2024, they had an underwritten loan to value ratio of 54.02%, which is down from 58.37% looking at that same time period during 2019. If you look at debt service coverage ratios, again, debt service coverage is just a mathematical equation. It's NOI over debt service. If NOI and debt service were the same, you'd have a 1.0. Lenders typically want at least a 1.25 cushion, which means 25% more NOI than debt service. If you look at these deals that have been issued here, debt service coverage ratio is down to 1.83x in 2024 compared to 2.2x in 2019.
So this segues nicely into a data point of the day we put out. So we looked at multifamily and office LTVs by vintage year, and you see a pretty clear trend for both multifamily and office sectors. So let's start with multifamily. Between 2019 to 2021, you saw the weighted average LTV hold very steady around 66 to 67% LTV. When we got into 2022, when interest rates started increasing and concerns about value declines started creeping up a little bit, you saw the LTV for multifamily drop from 66% in 2021 to 59.6 in 22. And we've held right around that 59 to 60% level in 23 as well. And by all accounts, it's looking like 2024 is likely going to hit right in that same area. So turning to office, you saw lower leverage in the office sector, which makes a lot of sense relative to multifamily, because for multifamily, keep in mind that includes not just the CMBS multifamily loans, but it's important to note this also covered the agency multifamily sector as well. So with the agencies involved, you tend to see higher leverage points in the multifamily sector. So for office in 2019 and 2020, in 2021, you saw LTVs ranging from 55 to 58%. It took a really slight downtick to 55.7% in 2022. If you remember the mindset we all had in 22, I don't think anybody was in love with office, but we weren't quite as pessimistic as we were in 23 and certainly in today's environment. So in 2023, it's wild to see this on a bar chart form. We went from 55.7% LTV in 22 to 49.5 in 23. So a massive deleveraging. For what Lonnie mentioned earlier about the decline in debt service coverage ratios as well, I mean, that tells you for leverage to be decreasing, which will decrease your debt service payment, for debt service coverage ratios to decline as well. I mean, that's telling you just how big of a bite interest rates have taken out of borrowers' pocketbooks.
So we get a lot of tweets and LinkedIn messages and emails from our listeners, so we really appreciate that. And this week, our friend on Twitter, K.A. Miller, sent us a story about short-term rental landlord Epic companies filing for Chapter 11 bankruptcy. Epic maintained a portfolio of 40 short-term rental properties in North Dakota. So this mention prompted us to examine the main types of short-term rentals and the story they tell about CRE markets in very different corners of the U.S.
Yeah, short-term rentals have been, depending on where you sit in the economic cycle, from an operator perspective, either really productive for you if you're an owner of a short-term rental, or if you're a hotel competing with them, potentially really negative for you. If you're a municipality or someone that collects hotel tax revenue and other things, this has really created challenges, and a lot of cities have moved to pass, ordinances or other regulations to try to reap the benefits of the short-term rental phenomenon. We did, as you mentioned, Haley, an analysis here, and what we started to see is kind of significant pushback from some major cities. So if you look at New York City, they're cracking down on short-term rentals aimed at tourists. They've cited negative impact on the multifamily supply, pushing apartment rents higher and lodging prices lower. The New York City Comptroller's Office found that 9.2% of the rent increases from 2009 to 2016 were due to Airbnb, and their longstanding rules were largely ignored until September 23, when the city launched a host of a registration process to verify compliance, and then Airbnb agreed to block invalid listings. So as a result, short-term rental catalog thinned by about 90% in less than 2 months. So as soon as people had to register and then pay the commensurate fees, they obviously stopped providing those services. If you look at line item financial data from Trepp, from 2017 to 2023, gross potential rent for multifamily properties in New York City increased about 116%, from $24.76 a month to $53.56 per month. If you look at the Epic's company's case, you've got a new era of Western frontier boom towns, which have been supercharged by the COVID pandemic, which created this demand for sizable short-term rental, like a kind of its own ecosystem or economy. You had tenants were remote workers, they had resource extraction, both jobs popping up in discrete time frames. So like you had oil shale booms in the Dakotas where Epic was at. And we've seen this in my home state of Texas, where you have these oil and gas booms where when oil prices are high or natural gas prices are high, people post up. They basically live in a 8x8 whatever, call it a unit, and they pay a really high price. But as soon as the market and the oil or gas goes down, they move out, and those cities go back to being ghost towns. If you look at the Trepp data here, from 2017 to 2023, GPR, gross potential rent for multifamily properties in North Dakota, increased about 26.6%, from $808 a month to $1,031 a month. So I think this is indicative of kind of the bifurcation between this STR, short-term rental narrative. You have large established cities that have an Airbnb problem where people don't register and don't pay the fees. When the cities crack down or they ban them, obviously there's benefits to the multifamily owners and to the hotel owners. You have these others, like in the Dakotas, where you're really playing with fire in the sense that you had a short-term run-up in demand that's not going to be sustainable when the market turns. And I think that's what's happened here to Epic. They've benefited when the market was really hot. That market has slowed down, and you're starting to see the impact felt across their portfolio.
Yeah, if you think it's hard to underwrite an office property on a 10-year pro forma, try feeling good about your assumptions on a short-term, rental property going through a cycle. It's so incredibly difficult to forecast your rents, occupancy levels. I mean, just a host of factors. These are incredibly difficult to pro forma out as long run deals. And I'm right there with you, Lonnie. Like, if I'm going to value one of these things, I want to bank on like 1 to 3 year strategy and not pay, that 10-year premium.
Listen, in Texas, we've seen truck drivers that drive water trucks for these fracking rigs making $150,000 a year just driving a semi to go and take the water for the extraction. And you've seen hotels like a La Quinta type hotel that in Midland, Texas generally rents for $59 a night at $600 a night. And they trade at crazy multiples and crazy sales prices. And the reality is, as soon as the rig shuts down and there's no demand for those employees anymore, guess what? You're left with a hotel that's back to $49, $59 a night with no warning. And so, we've seen this with WeWork. We see this in the short-term rental space. And I think at some level, we haven't done the analysis, but you're going to see the same type of phenomenon on the mobile home parks and some of these other last affordable housing kind of push that we saw in the last 4 or 5 years, where they traded at crazy low cap rates and really high revenue numbers when occupancies were really strong. And you started to see a little bit of pullback there. And I think you'll see some stories of some of these mobile home park operators struggling heading into the next couple of years as well.
Oh man, don't beat on my favorite cash cow. Love mobile home parks. Love them.
Well, they're kind of popped up everywhere. I mean, it's kind of like the self-storage segment too, like these, what we would consider to be non-traditional income producing investment properties for the last 10 years have really become one of the favorite asset classes. But I think we're starting to see a wind down there where, guess what? Desolate or remote mobile home parks in rural areas are not going to be, viewed favorably when you can buy apartment buildings, in some locations at a discount, given the stress that we're seeing in some of those markets.
Fun blast from the past quiz question for you, Lonnie. Fun little backstory too. I did live in a single wide trailer in college for a brief period of time. This was a 2-bedroom, 2-bathroom. And my monthly rent did include water. So how much was I paying per month on the outskirts of Athens, Georgia?
What year was this, Stephen?
2004.
I'm going to say $275 a month.
250, close. Very good. 250 a month. And I was the only one living there. I was living the high life. It's great.
Listen, at this point, I don't think you could rent a tough shed anywhere in the US for $250 a month that had any type of utilities, let alone water included. So those are the good old days.
So now let's look at a bit of an academic analysis that was done here in this sector. Carl Gershenson, Jacob Haas, and Matthew Desmond of Princeton, alongside Olivia Jin of Stanford, put together a great paper titled Fracking Evictions, Housing Instability in a Fossil Fuel Boomtown. And this was published back in December 2023. Rural counties like Williams County, North Dakota, experienced rapid in-migration of oilfield workers and, consequently, acute housing shortages. The relationship between commodity booms and housing instability exists because its housing market is tied so tightly to the production of a single commodity. Long-term residents are displaced by higher-income workers linked to the oil fields. One working paper finds a small but significant increase in mean rents in Pennsylvania's fracking-friendly Marcellus counties, as opposed to those of New York, where fracking was banned. While the median effect size is small, they estimate fracking to have caused a $250 per month rent increase in around 10% of in-sample census tracts. Qualitative accounts of housing markets in boomtowns, however, document much more severe increases in rent. As early into the boom as 2010, locals reported that motels had no vacancies, and some 2-bedroom apartments had seen monthly rents triple to $1,000.
And then we wrote about some headlines for some of the malls that we track: tenants downsizing and an extension on a mall loan.
Sure, so let's cover the extension first. Brookfield Property Partners, which owns the Town East Mall in Mesquite, Texas, and the Tucson Mall in Tucson, Arizona, has asked that the combined $324 million mortgage against the properties be extended again, this time by 3 years. And this comes to us from our friends over at CRE Direct. The debt against both properties matures next month and makes up 100% of the collateral behind a 2012 SASB deal. The loan had matured in June 2020. Brookfield then negotiated a one-year extension for the loan, which at that point had a balance of just over $567 million and was also secured by the Fashion Place Mall in Murray, Utah. The extension agreement, struck with the special servicer Wells Fargo Bank, included options to further extend the loan's term. In May, we wrote that the Tucson Mall loan transferred to special servicing in April due to imminent balloon maturity default. Now, the Town East Mall loan has also been transferred to the special servicer for balloon default. The Town East property was 80% occupied during the first quarter, with a debt service coverage ratio of 1.77 times. The DSCR at year-end 23 was 1.83 times, and it was 2.07 times in 2022. The property was appraised in June of 2021 at a value of $187 million, and that's down from $254 million in 2012. The Tucson property, meanwhile, was 93% occupied in the 12 months ending March of 2024, with a DSCR of 1.16 times. The property was appraised at a value of $121 million in 2021, and that's down from $400 million in 2012.
And I have another mall story here, Stephen. This one is tied around an anchor tenant downsizing. This is for the Fairfax, Virginia Mall, Fair Oaks Mall. JCPenney's, which occupied an anchor spot, is going to be reducing its footprint at the 1.5 million square foot shopping center. This story comes to us from the Washington Business Journal. The retailer owned its own store, but 2 years ago sold it to a venture of the Meridian Group and Martin Diamond Properties and leased it back. So they actually did a sale leaseback when they did some restructuring. The venture acquired the building and planned to subdivide the space that the retailer is planning on giving back. If you look at the mall, though, broadly, owned by Olsham Properties, encumbered by a $158.5 million loan, which, as we talked about earlier in the podcast, this one is split into 5 different CMBS deals. In May of 23, the loan missed the balloon payment date, had transferred to special servicer back in February of 23 due to the expectation the loan was not going to pay off during its May maturity date. We wrote about this loan back in April of 24 when Olsham Properties acquired the 50% stake it didn't already own in the Fair Oaks Mall as part of a deal that included negotiating a 3-year term extension of the retail properties CMBS loan. The loan has 2 more 1-year extension options. If we look at previous commentary, the extension is going to increase the borrower's commitment to the property, motivate the borrower to stabilize the property, and increase the value of the collateral. The mall collateral contains about 780,000 square foot of the aforementioned 1.53 million square foot shopping center. The property was built in 1980 and renovated in 2014. It's in a very heavily populated area at the intersection of Interstate 66 and US Route 50. And previously lost its Sears anchor, which didn't secure the loan. It was a non-collateralized part of the loan. Was both backfilled by Dick's Sporting Goods and Golf Galaxy. It also lost Lord & Taylor, which had previously occupied about 123,000 square feet, again, of non-collateral space. That space remains empty. If you go back to 2023, the property was occupied at about 92%, with DSCR and net cash flow at 2.01x. This is one where we'll see if this venture between Meridian and Martin Diamond Properties is able to actually take this JCPenney store, take the newly vacated space and subdivide it. Sometimes that actually provides a boost for the center. And in this case, that's what we're hoping for. So Haley, as we wrap up this week, there was one other thing I wanted to just get on record here. News broke today, Stephen Ross is going to be stepping down as chairman of the related companies and effectively starting a new company, I believe at the age of 84 or 85, called Related Ross. So we'll be following this story. This broke while we were recording the podcast, but we'll have some additional details in next week's episode. I think it's really exciting to see him venture out. This is going to be a Florida-based endeavor for him. And to see someone, at his age with his experience still jumping out on his own is really cool to see. And so we'll have some more insights on this, but thought it was noteworthy. Wanted to make sure our listeners knew we still had our hand on the pulse. We just didn't have the full details on this, given the fact that we're recording the pod real time.
So turning to shout outs, we had another message on Twitter this week after we talked about a story about Humana last week, and Jimbo on Twitter, and also I think Lonnie, you got some LinkedIn messages about this, gave us some more color about recent news. So maybe we can give a quick shout to that story.
Yeah, so I wanted to have a little mea culpa here that I was talking about a story that took place, I believe, in 2022. I thought it was more recent with Humana donating a building to University of Louisville. The question I think that was posed last week that I should have been answering is that Humana is effectively moving all their people to a building in the CBD that's much more of a Class B building and out of their trophy building. This news is worse than just Humana downsizing and moving out of a trophy building into a Class B building. There was another LG&E in the last year or two announced they're also leaving their downtown tower. So two of the flagship towers are effectively without tenants at this point, which, you know, is going to have long-standing implications for the downtown Louisville area. So just to clarify, we did cover a story last week where we talked about Humana donating a building to University of Louisville. That did happen. They also have now decided to move their workforce into a smaller Class B building in the CBD and moved out of its really high-end finished trophy type of asset where they're currently at. And then LG&E, as I mentioned, is also going to leave their downtown tower. So not great news for downtown Louisville from the office perspective. Hopefully for them, they're able to attract some tenants. I know they've incentivized through some public-private partnerships to try to get some office tenants back in the form of TI allowances and other things. So hopefully that'll be enough to get some people into the Louisville CBD, you know, hopefully sooner versus later.
Brian B thanked us. He's a longtime podcast listener and was interested in subscribing to the rundown, so we sent him that link. Justin M is a podcast subscriber who is going back and listening to some old episodes, so we really appreciate it when everyone does that. He was on episode 254 and was interested in our Gordon growth framework and parsing the yield. So we have a blog about that, and we can also send anyone a sample spreadsheet if you're interested in that. Andre J is a podcast listener and is interested in making sure he's on the list to get Market Pulse webinar invites and our loan loss report that we talked about on a recent show. So we got you on those lists, and we appreciate that you said you love the show and love to listen. On Twitter, Dr. Platinum X replied to our segment last week about insurance costs killing CRE deals. Aaron E thanked us for the shout out. Andy C on LinkedIn said he's a big fan of the podcast and checks in with us every week. He said we provide current relevant information delivered in a straightforward format. Thank you, Andy. And Paul B gave us a shout out and said, good stuff, Lonnie and team.
I'm going to be seeing Paul B here in September. He's going to be at our Texas Tech real estate conference. So I look forward to shaking your hand, Paul, and saying hello again. I had one other shout out this week, Haley. Rahul I, student at Fordham, reached out on LinkedIn, said his dad told him to listen to the podcast. And so he said he's been checking us out and he wanted to thank us for what he calls great practical information. And he's excited to be a listener, and we're excited to have him. So thank you for checking this out, Rahul.
With that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.